Yesterday, we talked about what a stock is. You learned that when you buy a stock, you're buying ownership in a company. But here's the real question. Where do you actually buy that ownership from? Is there a website? Is there a bank? Is there a secret club for investors? No, there's something much bigger. It's called the stock market. And today, I'm going to explain how the stock market really works in the simplest way possible. Let's imagine something simple. Think of the stock market like a massive online marketplace. But instead of buying clothes or phones, people are buying and selling ownership in companies. That marketplace exists in the form of stock exchanges, like the New York Stock Exchange and NASDAQ. These exchanges are not gambling platforms. They are highly regulated financial systems where buyers and sellers meet. Here's how it works, step by step. Step 1. A company wants to raise money. Instead of borrowing from a bank, it decides to sell shares to the public. This first sale is called an IPO, initial public offering. Once the company becomes public, its shares are listed on an exchange. Now investors can buy and sell those shares freely. Step 2. When you open a brokerage account and buy a stock, you are placing an order. That order goes into the exchange system. If someone else is willing to sell at that price, the trade happens instantly. You buy, they sell, ownership transfers. It's that simple. Now here's the powerful part. Stock prices move because of supply and demand. If more people want to buy a stock than sell it, price goes up. If more people want to sell than buy, price goes down. It's not magic. It's basic economics. But what makes people want to buy or sell? News, company profits, economic conditions, interest rates, market sentiment, fear, greed. All of these factors move the market every single day. That's why sometimes you see big green candles, sometimes big red crashes. But remember this, the stock market is not the economy, and it's not random. It's a reflection of expectations about the future. For example, when companies like Apple Inc. report strong profits, investors become confident. More buyers enter, price rises. When companies disappoint investors, prices fall. Simple. Now here's something beginners misunderstand. They think the stock market is risky because prices move daily. But volatility is not the same as risk. Short-term movement is normal. Long-term growth depends on business strength. The stock market has existed for over 200 years. It has survived wars, recessions, financial crises, and it continues to grow over long periods because businesses continue to innovate and expand. So if I summarize everything in one clear sentence, the stock market is a regulated marketplace where investors buy and sell ownership in public companies. That's it. No mystery, no secret formula. Just buyers and sellers meeting on an exchange. Now in the next video, day 3, we're going to answer a very important question. How do people actually make money in the stock market? Is it only by buying low and selling high? What are dividends? And why do some investors hold stocks for decades? If you're serious about understanding investing properly, don't miss day 3. Subscribe to Dollar Radar. Comment day 3 below, and I'll see you in the next lesson. This is your financial education journey, step by step.